You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Well, welcome back, everybody. Welcome back to the Young Investors Podcast. We are back on video this week. That's always the way it goes, isn't it, Hamish? When we're like, oh, and guess what, guys? We're going to do video every single week from now on, and then the next 2 weeks, no video.
Yeah, you jinxed us a little bit with the first one that we did on video, and then what did we take? 2 weeks off. So now we're back. We'll do our best. Will we make any promises from this episode?
I don't know. Well, the first, so unfortunate. Like the first one was unfortunately because Andrew wasn't able to edit the podcast. And by the way, how's Andrew doing? By the way,
yeah, I think he's doing well. I've spoken to him a little bit, and he's a little bit further out west, so a little bit less of an impact, or direct impact on the ground at least so far. But I hope you're doing well, Andrew, and of course, all of our best wishes go out from us and from the audience as well, I'm sure.
Yeah, definitely. So, and that was the first week, and then the second week, I was just, what a pain in the butt that was last week. I was in Adelaide. I had all my equipment to record a good podcast, and I should also apologize for like the first 20 minutes of that podcast last week when my audio is just like potatoes. But yeah, I was just struggling. And we couldn't figure it out. We tried every setting, we changed things, we kept things, we just tried everything, and the audio just really was struggling last week. It was just a pain in the butt, wasn't it? But sometimes that's just the way these podcasts happen. We don't have too many that are like that. Normally we're pretty seamless. Yeah,
we haven't really had, because we were talking about it last week, we really haven't had any issues really all that much at all for a long time. We've been doing this pretty much week by week, I think. We haven't missed a week as well for a long time, so... Yeah, it's been very seamless. We're very lucky. We haven't had any corrupted files or anything like that, happening regularly. So, it's been pretty smooth.
We've been lucky.
Yeah.
And now we're back. So hopefully, fingers crossed, I won't promise anything, but hopefully we are back with video on the YouTube version of the podcast. Audio should be unaffected, but hopefully my audio's good this week. I did check it before and we're all fine. But with that said, lots to talk about today. I'm going to talk about the oil situation that's going on. Well, you're going to talk about it because I don't pay attention to oil, must be said. A little bit of CPI stuff. We'll talk about Amazon. They're doing a 20-for-1 stock split, so we'll talk about that. And maybe another couple of things. There was an executive order from Joe Biden about cryptocurrency, which is quite interesting. Kind of the US's plan, what they're going to do about cryptocurrency. So a lot of people were waiting for that. I wasn't, but I know a lot of people were. And if we get time, we'll talk about a couple other stuff, some media and entertainment news, but we'll see if we get to that.
We'll see what we get to. We've got a fairly jam-packed episode today, so we'll do our best. Yeah. But with that said, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically or manually using Excel or one by one. And once you do that, it will track all of the different types of gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans on your index funds or individual stocks, it will do all of those calculations for you, which is a huge lifesaver. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track performance of your portfolio, as well as used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for as long as you want. Or you can also use that link to sign up to a paid plan and get 4 months off a yearly subscription. So go check it out.
Yeah, absolutely. Hey, we got a comment. I don't know if you remember this.
No.
We got a comment, from Road to Riches Investing. Hamish, how's that barber position? Because it went below $100.
Yeah, there you go. Yeah, so the story behind that is I think it was probably $180 or $160 a share, and it had already fallen a long way. What was it, down from $250 or something like that maybe?
Yep.
So it had already fallen a long way, and I was not interested in the business as taking a deep investment in them. And as a joke, I think I said it on the podcast. I said I would put 1% of my portfolio in if it fell below 100, and yeah, here we go. It's below 100. I actually put a little bit more than 1% in, and I put it in a while ago. I put about 3 or 4% of my portfolio in to it. I think at 120 or 130.
So that you've sunk like 15 million into Barber then.
Yeah. 50 million. Thank you very much.
Oh, sorry, 50. Yeah.
Don't understate my net worth on camera. Okay. No, so I just made a small it's a speculative investment. It fits within what I would consider like the 5% of my portfolio where I'm happy to kind of play around, have a gamble. And in terms of on the spectrum of gambly investments, it probably leans much closer towards a reasonable investment than a highly speculative business anyway. So
I don't think it's that speculative.
So yeah, but I actually cannot believe it is below 100. That was a complete joke. And it just shows how you really don't know what's going to happen. I think it really speaks to the idea of if you have a list of great businesses and you've done the valuation, some of them are going to say the stock needs to fall 70% or 60% for it to be a buy. And I think that speaks to the point where you might think, when is that ever going to happen? And we're seeing it in Bubba. I don't know what Bubba is down now. It must be over 75%.
Yeah, probably.
I think, you have a Netflix, which is a huge American business, I think down over 70%, Facebook down well over 50%. We have a lot of businesses right now that are well below where they were even just 6 months ago. And things can change very, very quickly in markets, and you got to be nimble on your feet and ready to go.
Alibaba's down 67% from its highs that were back in October 2020. Let's have a look at Facebook. Facebook is now down, we'll just take it from their earnings report, down 40%.
Oh, 40. Okay, my bad. Yeah.
Jeez. Oh, what did you say?
I said 50. Yeah.
Oh, okay. Well, I mean, it's not far away.
And what's Netflix? I think Netflix is down significantly as well. I think Netflix has to be over 50%. I don't know.
Oh, wow.
About 50%. Yeah.
50%. Yeah. So I saw a funny suggested post on Twitter the other day. It's just like, is it okay if my portfolio is 50% Meta and 50% Barber? I was like, oh, lol. But yeah, it is weird. And we don't want to try and say anything that might, sway your opinion one way or another on any stock. But it is crazy. If you just look at the numbers, just look at the cash flows and do a discounted cash flow analysis, regardless of whether the business is good or bad or has risks or no risks, on paper, it's crazy seeing some of these big stocks looking quite cheap at the moment.
Yeah.
So we'll see. We'll see what happens. But if these stocks are kind of interesting investments for you, and they're stocks that you do believe in, you've had your eye on for a while, then you've got a pretty good opportunity.
Yeah.
But with that said, you want to talk about what's going on with the whole oil situation around the world at the moment?
Yeah, and I'll preface this by saying I'm in a very similar position to you, Brandon, in that neither of us follow oil regularly. We're not oil investors. I don't know much at all about what's going on except for the headlines that we're reading that are substantial. So the headline this week was that oil prices are soaring after US bans imports of Russian oil. So another big move in, I guess, the economic conflict that is kind of surrounding the military conflict going on between the Ukraine and Russia at the moment. The US announced a ban which sent the price of crude and Brent oil up to $128 and $130 a barrel. It's pretty funny, actually. It wasn't, what was it, 2020 when there was when the futures were negative?
Yeah. That's right. It was crazy.
Yeah, so it's an amazing kind of it's been a crazy market, the oil market, and we don't really watch it all that closely, but it's just been it was about $60 a barrel, I think, pre 2020. It went negative, and then it went back up to 60, 80, 90, and now we're over 100, well, close to 130 for both types of the oil, which is kind of crazy.
Yeah.
At the same time, we kind of had a flow-on effect from some other regions, some other nations also making some decisions around Russian oil as well. So the UK and EU plan to phase out some Russian oil and gas imports by the end of the year. So they haven't been as aggressive as the US. The US said, we're banning imports. The EU just said, we're gonna work on it. We'll phase it out towards the end of the year. And the key reason behind that is because the EU is very reliant on Russia for oil and gas. 25% of EU oil comes from Russia, and about 45% of their gas comes from Russia. So,
sheesh.
They're heavily reliant, and it kind of makes sense. They can't be as aggressive, or it would absolutely cripple the prices of those commodities for everyday consumers. And that's really the end impact that we're seeing. We're seeing petrol prices rise all around the world, and at an insane rate. Have you seen in Canberra, have petrol prices just skyrocketed?
Yeah. Honestly, I was a little bit oblivious to it because I don't pay for petrol anymore. So I kind of have bypassed that equation.
Wow, look at you, Mr. Green.
But yeah, I looked the other day and petrol's like almost $2 a litre. I don't know what it's like where you are, but I imagine it's probably about the same.
Yeah, I think it was about $2.20 was the average across Melbourne. I feel like I saw that on the news, which is kind of quite high. I think this last week, I think it was about $1.80. So pretty substantial increase, which is interesting. It's just something we didn't expect to see. Good
advertisement for driving EVs though, or for buying EVs.
Yeah, that's true.
For context, like I don't want to seem like I'm on my high horse over here. Look at me, I've got a Tesla kind of thing. But to charge my car at home will cost me about $15. And that'll get me like 500 kilometers ish, maybe a little bit less.
Wow.
Yeah.
I didn't realize it was actually that different. That's actually crazy.
If I go to the supercharger, I'll end up paying, so I think somewhere like between $25 and $30, I think. But they don't really want you. They want the superchargers not to be like regular charging. They want it to be charging for road trips.
On the road kind of thing. Yeah.
So they want you to charge it at your house. But yeah, I mean, you think about it. What would 500 Ks of petrol cost? What would 500 Ks of electricity costs? And it starts to, and this is the argument, and this is what, Brandon, but I don't have the money to put towards an electric vehicle because they're still so expensive. That's still the problem. Obviously, EVs still need to get cheaper, but you do have to do a little bit of future planning in your head. Okay, if I'm going to spend $100 a week on petrol or whatever you spend on petrol, how much are you going to save just by charging it with electricity? And over time, how much is that going to save you? And clearly at the moment, not saying that this is going to be the new normal for petrol prices, but at the moment, it's a pretty strong advertisement for EVs, I guess. But
I think for someone like me, it would be much less of a difference because I really don't drive anywhere.
You don't drive that much.
But for the average person who's commuting to work, for example, every single day or whatever it is, then or dropping the kids off at school every single day, 2 times a day kind of thing, then it can. That's crazy. I didn't realize it was actually such a big difference. You definitely have to factor in the ongoing costs.
Yeah, no, I haven't paid for servicing once. They don't need servicing. Occasionally you get your wheels rotated, you might get your brakes checked or something like that, but there's no oil, so there's no oil changes, nothing like that. So you save a lot of money in a lot of different ways. But it's very interesting. There's just 2 different philosophies and 2 different kind of expense profiles. Electric vehicles, the expenses at the start and then not after that, whereas the other way around for ICE vehicles, there's a lower expense at the start but more expense after the fact. So yeah, it's interesting. But yeah, crazy. Going a little bit off topic. But yeah, you're right. It's pretty insane that oil prices have gone up so much, but it does kind of show you how how much I guess economic power the oil producers have. It's like, if there's an embargo, if we lose one of them, then this is the kind of impact for everyday consumers. It's kind of crazy.
Yeah, and speaking on that impact, there's a lot of concern right now that Russia will actually retaliate by stopping sending oil to the EU. So that's kind of up in the air at the moment. What will Russia do? Of course, Russia is dependent on those oil exports for their economy significantly. I want to say, I don't know the percentage actually, so I won't say, but it's a significant chunk of their revenue which comes in is from oil. So whether they'll be able to retaliate, I don't know, but the president of Lipau Oil Associates said that if Russia did retaliate by stopping sending oil to the EU, then that alone could send prices up another $25 to $30 a barrel, which would bring the price to $155, $160 a barrel, which is kind of crazy. So that kind of shows you how much of an impact a move like that could have, and how much money is and how much oil really is flowing between Russia and the EU, and then these other nations as well. So it's
that's pretty insane.
Yeah, it's very concerning to watch. I think I don't want to be all doom and gloom, but whenever I see all of this, I start hearing Ray Dalio in my ear about the threat of stagflation, which is something that he's spoken about even before any of this was going on. Stagflation being a period of high inflation but slow real economic growth. So nominal economic growth could still be significant, and that will be driven by inflation. But after factoring in, after taking out inflation, if economic growth is in decline, if it's not growing, then we could be entering a period of stagflation. And that doesn't seem, I think, out of the realm of possibility. We have prices surging on everything. I'll talk about inflation numbers that are coming out for February in just a second. But price surges are being driven by essential categories like food and now petrol, now oil. Plus, on top of that, if you add in the fact that interest rates are going to be going up or should be going up to combat some of that inflation, then those are three things, food, petrol, and housing, that people really can't cut back in a substantial way, which means they have to cut back in other areas. And I think that's definitely a threat that we could see a period like that. And that's the worst kind of period you want to see, because then we get into that situation where the Fed has to decide, do they save the economy by lowering interest rates and doing monetary stimulus by printing money and buying assets, or do they stop inflation by raising interest rates? But that would further impact businesses, cause more layoffs, cause higher mortgage rates. So it's a bit of a pickle, and we're not quite there yet. But we may very well be heading towards that, and that's kind of concerning.
Hello, everybody. Brandon from the future here. Sorry to splice in this little bit of audio, but I thought that I would do this because actually what I went on to say after Hamish finished talking there, I realized after the fact actually had an error in it. So what I was about to say anyway is that I definitely agree with what Hamish was talking about, but it was very interesting to see that on Wednesday, WTI crude tumbled 12% and Brent crude tumbled 13%. So pretty much what I was talking about. It's just that it's crazy how volatile crude oil prices are at the moment. I mean, we're seeing obviously all of the factors that Hamish was talking about, which are leading to the inflation of fuel prices and of crude oil prices. But it's crazy to see that also in a day you can see like a 13% reduction. There was so much worry about this idea of Russia just going, you know what? You know, we don't like what you're doing at the moment, US, UK, and EU, so we're actually going to stop our exports and then see how you like that, Europe, because as Hamish was saying, Europe is very dependent on Russian oil. So that was obviously causing the price to rise. But interestingly, the day that the crude oil dropped by 13%, there was actually word out of the UAE, which is of course a member of OPEC saying that they would be open to increasing their production. And I think Iran also signaled that they would be happy to increase production as well if OPEC Plus were to ask for it. Now, the interesting thing about this whole story, and this is really where a lot of the unpredictability comes in, is that Russia is a part of OPEC Plus. OPEC Plus is, of course, the big alliance between many oil-producing nations to control the amount of oil that goes onto the market. So, in a way, if OPEC were to turn around and say that they were okay with increasing the production of crude oil, they would kind of be stabbing Russia in the back because Russia is a part of that OPEC Plus alliance. But I mean, really, the point that I was making in the bit that I've now deleted out of the podcast is that it's crazy just how volatile oil is at the moment. And I think we can go back to something like Warren Buffett's idea of the too hard pile. It's perfectly okay. I think we as investors, we know when we see an event happen, whatever it is, we feel like we want to act. We want to take advantage of this event. We get trained to make investments based on events that cause sudden price fluctuations. But I think it's also worth remembering that it's okay to chuck things in the too hard pile. And I think when I look at oil, the fact that there's day-by-day news that's causing the price to either jump or fall 10, 15%, 13%, I think for me personally, this one goes straight on the too hard pile. Maybe you're different. Maybe you're an oil expert. Maybe you've studied OPEC in great detail. Potentially, I don't know, but I think for me anyway, it definitely goes on the too hard pile. But anyway, with that said, that is the reason why oil suddenly dropped 13%, and now I'll go back to, I guess I'll go back to us. All right, see you later.
Yeah, and from a value investor portfolio perspective, none of these things should be influencing your investment decisions except if they open up the opportunity for you to get in a good business at a better price. That's really what it is. It's of course it's important to kind of keep up to date with what is going on, and these things have real impacts outside of the financial markets. The oil prices certainly has significant impacts on the cost of living for people. But from your investment perspective, I'm not making any moves based on what's going on with oil or really anything at all that's happening in the news at the moment. So. Yeah.
Yep. All right. Where to, Hamish?
All right. Should we talk about inflation? I think we should.
Of course. We haven't spoken about it in a week.
No. Yeah. It's been a whole week.
Yeah.
No.
So what's going on?
Yeah. So by the time you're listening to this podcast, the February inflation numbers will be out. So we don't know. We're in the dark again.
Oh,
so
we're gonna miss it again.
We're gonna make another prediction. But just to give you the headlines for what we're kind of up to date. I guess this is kind of pointless though. I guess if you can just read the headline and see what the inflation is. Yeah. But last month in January we had a 0.6% increase. 7.5% year over year. Economists are expecting February to be 0.7 and reach 7.8%. So that's what they're expecting a day before it happens. Let's see how accurate they are. Maybe they'll get it right. They were pretty close last month, kind of.
Yeah.
Not really. But
jeez.
But yeah, should we make a prediction? So economists are saying 0.7 on the month and 7.8. I know you don't know. Neither of us know, but let's make it.
No, I mean, I don't know. I feel like that sounds about right. I think that inflation is still, I don't think it's going to start going down. It doesn't seem, not that I follow this particularly closely, but it doesn't seem like any of our inflation issues are really going away. In fact, they've probably got worse over the past month or so with everything that we've been talking about. So yeah, I probably would tend to agree with the economists, but I don't know.
Okay, let's assume.
I'm going to say 8%, just because I kind of want it to be shocking.
Okay.
Some people just want to watch the world burn. Seriously, who would have thought though? Imagine if it came out tomorrow and they were like, "Yeah, we're at 8% annual inflation."
Yeah, we messed up big time. It's 17%.
Yeah, I know that we talk about that other scenario, but imagine if they just that kind of worries me a little bit. But
yeah.
Anyway, what's your thoughts?
Yeah, I probably agree with you. Probably, Yeah. I don't know. Yeah, I'll say 8%. Nah, it's boring, actually. I'll say 7
I'll tell you what, say 7.9 because that's what they would do, because they'll be like, guys, inflation just hit 8%. And then they go, can we just tick it down by 0.1 so that it's still in the sevens?
Yeah. They do the retail pricing strategy. Yeah. $7.99.
Yeah, I would. Yeah. Inflation going cheap now. $7.99. Definitely not 8. It's $7.99.
My goodness. Yeah, but there's kind of the big news, I guess, around inflation is that all of this oil impact has happened in March. So none of this will really be seen, and most of it won't be seen in February, which means that inflation.
Smokes, what's March going to be?
Inflation is now expected to be in March a year-over-year of 9%, which is it's getting up there.
Wow.
It wasn't all that long ago. We're at 4-5%. And, getting anywhere near 10 seemed just, no, that's not going to happen. But here we're getting very close to it. So we'll see. I mean, that's 2 months out. Economists can't predict what's going to happen tomorrow. So,
that's true.
We'll take that with a pinch of salt. But,
yeah.
But yeah, and then next week we'll be able to talk about what the Fed did at their meeting. So whether they'll raise interest rates, they're expected to raise 0.25%, but whether they'll do that or 0.5 or nothing, we will see next week. So lots of fun stuff to look forward to in the economy.
It's very depressing. That's the sad thing about this podcast, really, over the last little while. This has just been like, and this week on the Young Investors Podcast, more stuff goes wrong in the world economy.
It's been a rough couple of years for the human race. I'll tell you what. I mean, we've had the pandemic, and we've got this war going on, and we've got inflation, and we've got oil prices surging.
It's like in Australia, we had really bad bushfires like a few years ago.
Bushfires.
That seems like a distant memory.
Yeah. We've got the floods going on.
Yeah, there's floods at the moment. There's political unrest. There's war. There's inflation. There's just the whole. Can we just have a period of just chill?
Yeah.
Probably not. Probably not. It's a changing world order, as Ray Dalio would say.
It's a new paradigm.
Time to rest.
New paradigm
shift. Yeah. Anyway, we need something happy to talk about.
Yeah, I've got something happy to talk about. The Batman came out last week. Did
you see it? Did you?
I did actually see it. I really enjoyed it. I'm a sucker for really good coloring in a movie, like visuals.
You like a nice color grade on it.
Yeah, and it's got really good like 1970s Gotham CGI, and it is just unbelievable to look at. And the story's good as well, but I'm a sucker for a really good soundtrack, really good cinematic soundtrack, and good visuals. And it has to be the highest budget movie ever, I think.
I
don't know. It was, I think it was, I want to say 200 million was the budget.
Oh, Batman.
I don't know. Let's have a look. I think it was pretty significant. But of course, after 185 to 200 million was the budget for that movie. So they put in a little bit of money. They put some money into it.
Just a little splash of cash. How'd Cedric Diggory go?
Yeah. So he was good. Yeah. So
he was good.
Yeah. So over the weekend, unbelievable weekend. They did 134 million in North America. In box office sales, and globally in total they did $258 million, which is the second highest post-pandemic the second post-pandemic release hitting over $100 million.
Right.
So
250 on the opening weekend is high.
Yeah. I think it was maybe top 30, I want to say, or something like that. Top 40 of all time. Yeah.
Yeah.
So yeah, it's done unbelievably well. Obviously, probably a lot of people who haven't been out, still kind of going out to the cinema maybe for the first time or for the first couple of times since the pandemic. So it was kind of sitting on the back of that. But it also Warner Brothers, it was kind of the first exclusive release from Warner Brothers in theaters after all of their 2021 releases came out simultaneously on HBO Max. I didn't actually know they did that.
Me neither.
Which is, yeah, that kind
just
of
dump them on them. Here's our content.
here it is.
Enjoy. See you later. See you next year.
Yeah, I wasn't aware they did that. Which, yeah, I guess that's kind of a smart move. But now they're moving back to doing 45 days exclusively at theaters before they will move to HBO Max. So there's a little bit of a window, but content's moving quickly onto streaming services. Even 45 days is not a long time to be able to then, as just a subscriber of HBO Max, to be able to get access to that movie. So very interesting.
Remember the days when you used to, you had a window of opportunity to go see a movie at the theaters, and then after that you had to wait. Yeah. There was no way of seeing that movie until you got the DVD release.
Yeah.
You just had to wait for it.
Yeah.
That was it.
Yeah, it would be so long. And then once you would go to Video Easy or Blockbuster, and it would be, as soon as it came out, it would be like $8 to $12 to rent it anyway. So that was kind of insanely expensive.
Yeah.
You had to wait a number of months before it got down into the $3, $4, $5 range, and Mum would finally say yes.
All right, there you go. Here's your $3.
Yeah.
Go for it.
It actually is interesting because we're kind of moving out of the world of using box office dollars as a measure of how successful a show is to probably watch minutes or number of households is probably what we're going to see going forward, which is what Netflix does exclusively, because they don't do... Well, they do. They actually did a couple of theatrical releases. They released the first part of the Kanye West documentary in theaters, which is kind of an interesting move. But the vast majority of Netflix content, of course, does not come out in theaters. So they just measure everything by how many minutes people watched. And that seems to be what's going to happen over time. And that'll be interesting, because then we'll also be able to see somewhat of a comparison between the performance of these huge movies and like a YouTube channel, right? Because you can measure the performance of a YouTube video or an entire channel on watch minutes. So everything's kind of consolidating in a way, which is interesting to see.
Yeah, well, it makes sense that you can't judge it, because Netflix is subscription. It's like, I don't have a subscription to the cinema where I can just go. Yeah, so they can't judge it by a financial metric like ticket sales. So they have to judge it by just looking at what content is most popular based on how many people have clicked on it and how long they're watching for, same as YouTube. And then they use that to make decisions on where they put the money that they get from their membership. So it does make sense. But yeah, it is interesting seeing that. I think box office is very legacy.
Yeah.
I think it's less and less relevant. Especially with the rise of streaming services. But yeah, long story short, I'm glad that Batman is good. I need to go see it. I'm not a huge like Marvel or Warner Brothers or I'm not kind of a huge fan. Like Star Wars is my jam, but the other ones I never really got into, probably because I was watching Star Wars. But no, I am happy that the Batman is getting good reviews. I don't mind a good Batman movie.
Yeah, I'm not huge into comic book movies either as well. I couldn't tell you the backstory or anything like that. And yeah, I'm not keeping up to date with all of the different Marvel movies or anything like that. But it was a good one. It's long. It's 3 hours. So you got to strap yourself in. You have to get some snacks to survive through that. But yeah, it didn't feel that long, honestly, to me. I reckon the first 2.5 hours went quite quickly. The last half an hour, I think, is always kind of... You always just wanted to get it done.
Yeah. I was talking to my mate who works in the industry. It was like back in the day, things were so long that they had the intermission break and then it got shorter, and now the trend is reversing again. Everything's getting longer again. He's got, soon enough, we're going to need an intermission again.
Yeah. And I mean, I tend to... I don't know. I tend to binge watch TV shows at home anyway. So that's probably me basically watching a 3 to 5 hour movie just in one sitting. So.
Yeah, exactly. Yeah. People don't realize, they think, 3 hours for a movie is so long, but they'll watch three 1 hour episodes of a show back to back.
Yeah.
But there you go. Anyway, should we move on?
Yeah. What have we got?
All right, we'll talk about Amazon for a bit. So Amazon are doing a 20-for-1 stock split, and they're doing a $10 billion buyback. So Amazon announced its first stock split since the dot-com boom, telling investors on Wednesday they'll receive 20 shares for each share they currently own. The stock soared 6% on the news, which is pretty ridiculous because stock splits, they don't do anything.
Yeah. I hope.
But there you go.
Yeah, I hope that 6% increase is related to the buyback and not people thinking that the stock split does anything.
Yeah,
let's just say that.
Although, for some reason, buybacks, just a general trend over the last couple of years, buybacks have led to an increase in share prices. I think Apple did one. Did Google? No, Google hasn't done one. It was Apple. Tesla did one.
Google's planning on doing theirs, yeah.
Oh, okay.
Yeah.
But I think the Apple and the Tesla stock split just, I don't know why, but just sent the stock up because stock splits, they don't have a material impact. It does nothing. It's the same. It just means you get more shares, and because you get more shares, the share price falls in. It goes like that. But net, you're still exactly the same. So it has no reason to move. But yeah, very interesting. So it says, were the split to happen as of Wednesday's close, the cost of each share would go from $2,785 to $139. And yeah, each existing holder would get 19 additional shares for every one that they own. Amazon joins, this probably says it right here. Amazon joins a parade of highly valued tech companies pulling down the price of each share through a split. Google parent Alphabet announced a 20-for-1 split in February. Mid-2020, Apple disclosed plans for a 4-for-1 stock split. Tesla told investors it was going through a 5-for-1 stock split. So, yeah, and then it even says here, stock splits are cosmetic and do not fundamentally change anything about the company, other than possibly making the shares accessible to a large number of investors because of the cheaper price. But even that's not really an issue because 80-90% of the market is institutional and they've got millions, if not billions and billions of dollars to sink in. So a share price of $130 versus $2,700 doesn't make a difference to them.
Yeah, I would be extremely surprised if that made a substantial difference. Maybe.
And
all I was going to say is maybe you would get something of an effect of where the stock might be less volatile if you didn't do stock splits because, take something like Berkshire Hathaway's Class A shares, that stock is, that if you sell a share, it's a significant chunk of your wealth if you're an owner.
You're not trading that.
No, you're not trading in and out of it. So maybe there's something there with that, but no, I don't think so. Yeah. I don't know why they more, I don't know. I don't know why. I guess it does make it more accessible to people. Whether it has an impact on the stock is another thing, but just to give more people an opportunity to get in on the company, I guess is a good thing.
That's what I always say. But at the same time, to kind of go for a rebuttal against that, most brokers these days, it used to be rare, but most brokers just do fractional share trading now.
That's true. Yeah.
So most brokers you can buy 1/10 of a share. So, but yeah, you're right. That's what I was thinking as well. Is it just accessibility? But anyway, so that's the stock split side of the news. Then we've also got the company saying that it's going to buy back up to 10 billion worth of shares. I don't know Amazon that well, but it doesn't look particularly cheap to me. I mean, it's cheaper than what it was. You remember when we were talking about Amazon used to have like a PE of like 180 or something? Do you remember the days when we were talking about that?
Yeah.
Now it's still expensive. It's got a PE of like 50. I don't think it's particularly cheap. So I would question, and obviously I don't know. I'm not invested in Amazon. I don't know it in depth. So maybe you can have a good rebuttal to what I say here. But I would question whether this is value adding or value destroying if they did buybacks at the current price.
Yeah, I don't know for sure. I know that when I first looked at Amazon very briefly a while ago, you're right, it did have that insanely high PE, I think like 250 or something like that. And a bit of a consequence of that, part of it was because the stock was very, very attractive and it was a high-flying growth stock. But also part of it was Bezos purposefully using the income statement to make investments in R&D and these other aspects that you can expense on the income statement. So their net income was artificially low, which is why the PE moved down significantly. And their bottom line has had massive growth. So that did have an impact, but I don't know the business well enough from a valuation perspective to know whether a 43 PE is reasonable. On the surface, of course, it does not look reasonable. I think you would struggle for most companies to justify a 43 PE, but who knows? I don't really know. But yeah, you're right. It could be value destroying. Really just depends on what the cash flows of Amazon are in the future and whether they're significantly higher than what the stock price is today.
Yeah. And so I kind of went down that rabbit hole. So I was like, okay, if this is value destroying, then naturally the next thing you do is you think, okay, wait a second, Jassy, new CEO, compensation. So a lot of CEOs, their compensation is tied to earnings per share. And if you do a lot of buybacks, so if you clear a lot of shares off the table, but you maintain your earnings, then your earnings per share can be higher. So I was like, okay, is he doing that? So I had a little bit of a look at their proxy statement, and I don't think he's doing anything dodgy to try and inflate the earnings per share or the stock price or anything like that. So I essentially found that their executive compensation at Amazon consists of base salary and then periodic grants of stock awards. So just and it doesn't seem to be performance-based stock awards either. It actually seems to be just time-based stock awards. So, they would make an agreement in 2022 for a vesting schedule of stock over the next, say, 6 or 7 years. So it says here that most of their executives' base salary is like $175,000. That's the same for Jassy. And then in terms of the restricted stock units, he has 48,000 units of stock that have not vested at the end of 2020. They receive stock-based awards every other year, and most awards vest over 6 to 7 years. But it's not tied. From what I saw from reading through their proxy statement, it doesn't seem tied to a performance metric,
right?
Or a total shareholder return or something like that.
Yeah.
So it's in their best interest to, for the stock price to go up over time. And you can argue, maybe if they have better EPS numbers, it'll make the stock price look better or whatever. But it doesn't seem like there's any sort of foul play to try and inflate EPS by doing buybacks.
Yeah. One thing you can kind of check with these time-based plans is what is the management team's behavior when they acquire these shares over time, because it's not influenced, as you said, by performance. So they're just getting regular influx of shares. Are they holding all of those shares? Are they selling most of them and cashing out immediately? Or are they accruing ownership, which is what the plan is supposed to do? But yeah, I definitely, I don't know how I feel about time-based vesting of these restricted stock units. I would certainly prefer, I think, if there was a significant portion tied to some fundamental parts of the business, whether it's revenue growth or whatever it is, EPS or cash flow, or return on invested capital is also a common one that can measure the management's effectiveness. So I always kind of think, why is there not a variable component in there based on that? And I get that over the long term, you want the management team to be aligned with the shareholders, which will ultimately be measured by how the stock performs. But and it looks like 6 to 7 years vesting is a long period. So they're not kind of earning a lot in the short term, which is good. But yeah,
I think it was like 11, or in 2020, he had 11,000 stock units vest.
Right.
So it's like, I don't know how that goes year by year, but 11. If it was 11,000 each year, I mean, it's still a lot, obviously, just in absolute terms, but it's probably not as high as what it potentially could be.
Yeah. I would certainly still prefer to see some variable component based on performance.
Oh, definitely.
Because, I mean, ultimately, that's the best measure of how the stock will perform over the long term. If the underlying business is doing very, very well, then the stock, as a consequence of that, will do well. Whereas the stock can be manipulated by moves like share repurchases. So, it's not always actually the best measure of whether the management team is doing things in the best interest of shareholders. So,
yep. Okay, that's pretty much all I had to say about that one. Should we mosey on down to this cryptocurrency thing that's going on? So obviously not particularly relevant. We're not huge into cryptocurrency, but probably a lot of you guys that listen might be interested in it. And there was a big question mark over what Joe Biden was going to do about cryptocurrencies. And a lot of cryptocurrencies were kind of, their price was hanging on the edge depending on the result of this executive order. So anyway, Joe Biden signed an executive order on Wednesday calling on the government to examine the risks and benefits of cryptocurrencies. It's a long-awaited directive that has had the crypto industry on edge, not least due to growing regulatory concern around the world surrounding digital asset markets. There has been reports of a divide between White House officials and Treasury Secretary Janet Yellen, leading to delays in the policy rollout. The crypto market got wind of the executive order overnight after the Treasury accidentally put out a since-deleted statement calling it historic and releasing some of the details ahead of time. The order was finally signed Wednesday. It calls on federal agencies to take a unified approach to regulation and oversight of digital assets, according to a White House fact sheet. So I'll go into a little bit of detail. It's essentially just the measures announced Wednesday will focus. So it's going to focus on 6 key areas: consumer and investor protection, then financial stability, then illicit activity, then US competitiveness on a global stage, then financial inclusion, and then responsible innovation. So I think this is kind of, it's not really a make or break kind of executive order. It's kind of just like, all right, guys, unified, we're looking into it now kind of thing. However, people were nervous because, obviously China has banned crypto mining. They're cracking down on it.
Yeah.
So crypto investors were concerned that the US might have done something similar, but they were actually quite positively reinforced by this, is that actually it seems as though the US is not looking to follow China's approach, but they are trying to embrace it, but doing their due diligence about the risks and the benefits of, cryptocurrencies. So we'll see what happens. Some of the things that got brought up was in terms of consumer protection, it wants regulators to ensure sufficient oversight and safeguard against any systemic financial risks imposed by digital assets. In terms of illicit activity, the president called for, quote, an unprecedented focus of coordinated action from federal agencies in mitigating illicit finance and national security risks posed by cryptocurrencies. He's also urging international collaboration on the issue. Then in terms of US competitiveness, Biden has tasked the Department of Commerce with establishing a framework to drive US competitiveness and leadership in and leveraging of digital asset technologies. And then the last kind of quote that the article had is, in terms of responsible innovation, Biden also dropped a mention of the sheer energy costs baked into digital currencies like Bitcoin. He wants government to study ways to make crypto innovation more responsible, reducing any negative climate impacts. So they're just some of the things. A lot of kind of government wish-wash nonsense, we're going to do something about it, or we're going to have a look at doing something about it. But I think overall the reaction was positive. And in fact, Bitcoin jumped 8% after the news. So
wow, there you go. Yeah, I guess they've just got to keep an eye on it, I think, because obviously currency is one of those things that the US government has significant control over, and that has its pros and cons, but being able to influence it in order to revive the economy during tough economic times and slow down the economy during hot times is one of the benefits. And if they lose that to a currency that they can't control, then I'm not sure. I think Ray Dalio thinks that's very unlikely to happen. So I'm sure they're kind of just watching it closely. But crypto is just the Wild West still. There are so many.
Yeehaw.
There's just No, not yeehaw. No, there's just there's just so many scams, and I guess, yeah, I guess that's always just going to be the case. But yeah, it's crazy at the moment. There's a big lawsuit going on at the moment with Jake Paul. He's being sued significantly because he promoted a number of cryptocurrency projects. He didn't disclose that he was being paid for those projects, and he collected, I think, about $4 million or something. So,
wow.
And it's all there on the blockchain. You can't hide from it. So
exactly.
Yeah, it's we're starting to see, I think, some people who are doing some dodgy stuff in crypto, promoting these projects and then just rug pulling money out. We're seeing some of it kind of come off, but it's still just, it's everyone's moving very, very slowly on this space. So.
And I mean, our exposure to it as well is like the YouTube comment section, so many Bitcoin scams.
Oh yeah.
It's crazy. And then, people fall for it and they send these Bitcoin to I don't know, who they think is Hamish Hodder or who they think is, Graham Stephan, but is not. And then all of a sudden they go, someone stole my Bitcoin. How do I get it back? This is not right. Well, I don't know.
Yeah.
Decentralize. Well, we can't do anything about it.
Yeah.
Interestingly, Joe Biden's also floated the idea of a US dollar cryptocurrency. So I don't know how that'd work, but there you go. They're floating the idea.
I don't know. I'm no currency expert.
I'm no this podcast has been like, I'm no oil expert. I'm no inflation expert. Don't know what's going on there. I'm no currency expert. But the Batman was good.
Pretty much. Pretty much.
Any more to say on that?
No, I don't think so. I don't know. I never really have anything to say on crypto. I don't know. I wish I had more of an interest in it. But I don't. Yeah.
And it's not that we hate Bitcoin. It's not that we hate crypto or anything. It's just a non-productive asset that we're not interested in. Do you own gold?
Do I own gold?
Yeah.
No. Yeah.
So same. It's like, gold market's going all over the place. Okay. I don't. It's a non-productive asset. I don't invest in it. Don't know anything about it. Sorry. Yeah. Yeah. It's just the way it is. All right. Do you want to do some Q&A?
Yeah. Let's. We got a couple.
We got what?
We did
6 minutes left or 7 minutes left or something.
We got a few minutes. I think we got a.
Hey, here's a big pressing question. I don't know. Have I asked you this one already? This is a very big question, Hamish.
Oh, you sure you want to do this?
How far will tech stocks fall?
All right, let me just get it up. Hang on.
To 3 decimal places.
That can't be right. Hang on.
This is saying 80%. Oh dear. Okay, I'll ask you a proper one. Do you have any recommendations on material for learning more about when and why to sell stocks?
Oh, that's a good question.
How do you go about it? Yeah, how what's kind of your general thinking when it comes to, or what's your logical thought process when it comes to when and why would you sell a stock?
Yeah, my thought process about selling is basically just the inverse of buying. So if when I'm buying a stock, a business has to meet all of the key Buffett principles. So a business we understand, one with competitive advantages, great management team, and selling significantly below fair value or intrinsic value. So just the inverse of that is some of the reasons why I would consider selling a stock. So occasionally businesses will start in one industry and they might adopt a new industry. So a lot of businesses in tech at the moment are moving into cloud, for example. If you don't understand cloud and it becomes a big part of the business that is going to influence how that business will perform in the future, its future profits, then you need to be able to understand that new business. So in my view, if you don't understand that business, if you can't wrap your head around it, then that would be a business that no longer satisfies that first requirement. And then the same thing kind of just applies across the 4 key areas. So if the management team changes, you need to reassess the management team. Are they still effective at investing within the business? Do you have a track record that you can look at to see, yes, this manager is a good, can allocate capital effectively over time? And, the same thing applies for competitive advantages. So I guess in terms of material, I would probably say still the best material is to go through Berkshire Hathaway's annual letters, either just going through them one by one, or read something like the Essays of Warren Buffett, which gives you kind of a consolidated look at the principles that he talks about over many, many decades that he's written those letters. So that's where I think you'll find the best material on when and why to sell.
Yeah, I think what you say is 100% correct. I just think the two reasons you buy, it's exactly what you said. It's the inverse of buying. So you buy when you found a wonderful company and it's at a margin of safety price. And you sell a company when it's no longer a wonderful company, or when when you've bought in now it's hideously overpriced and you want to sell. And, everybody has a different opinion on when to sell, like in terms of overvaluation. You've bought in, you've made a good gain on paper, and now, do I get out? Some people, I think both of us kind of sit more in the camp nowadays of just go along for the ride a little bit more.
Yeah.
If you still see the future, obviously there's a point at which the stock price is so expensive that maybe even in 10 years from now, then the business still, if they keep growing, they won't have caught up to the current share price, in which case you can be like, oh, okay, I'm getting a pretty good offer right now, Mr. Market. I might take that offer. But yeah, you can, I think that's, sell. It's up to you when you want to sell, when you're looking at a profit. Some people take a modest profit, it doesn't matter. You still won, you still made money. Well done. You win investing. Or if more importantly, if a business changes in a way where it's no longer high quality, then that's a telltale sign that you need to get out.
Yeah, I definitely lean more towards Charlie Munger's wisdom on selling based on price, which is that if it's still a great business, hold on to it. And the idea behind that is whenever I'm investing in a company, my estimation of intrinsic value, what it's worth, is extremely conservative. That's part of our process. So if a business exceeds that, if a great business exceeds that extremely conservative idea of what it's worth, we shouldn't really be surprised, in my opinion. And you shouldn't just assume that it is worth only as much as that extremely conservative approach that you took to valuation. That if a business that's a great company exceeds your expectations, that you should leave it in your portfolio and hold on to great companies. So that's kind of my thoughts on that. You
want to do this first one here?
Yes, let's do it. Hey guys, a year ago, I've bought a company and I think it's a pretty good business, but since then, I've learned a lot about valuing a company and now realize that I've overpaid for it. It came back down to my estimated level of intrinsic value, and I was thinking if it's better to sell it at a 30% loss and invest that money in something better, or just hold it and be patient since it's growing like I've estimated. What do you think about it?
This is a very interesting question. It's something that I haven't really thought about before. So you've from your estimations, you've overpaid by about 30%, and now it's come back down to what you actually do estimate your intrinsic value to be. I think you can take kind of two approaches. There is a case for selling if you can take advantage of some sort of tax loss harvesting. You can lock in a loss if that benefits you from a tax perspective, but you'd need to check I'm not sure what country you're from, so you'd need to check your country's laws around tax loss harvesting. But I think in Australia, for example, there just has to be or was that in the US? There has to be a 30-day period. Might have been in the US. There has to be a 30-day period before you buy back in. So you can harvest a loss, wait for 30 days and buy back in and they don't care. So you can do that. Or alternatively, if you have done more digging and you realize, crap, I should have bought it where it is now, or maybe even cheaper than where it is now, but I overpaid 30% for it. You can still look, okay, is this business, is the growth trajectory, is it going to get there and surpass that price, based on the business fundamentals? Is it going to get there eventually? Maybe it might take a few years, but is it going to get there? And if you still think it's a great business, then I wouldn't, personally, again, not financial advice in any way, but I wouldn't be rushing to sell something just because I overpaid a little bit for it. If I bought, say, a really high quality business and I paid a little bit too much for it, I probably wouldn't freak out because I bought a really high quality business. So I'd probably say, I trust the management team. The numbers looking good. The internal reinvestment's doing really well. I'll just hold on. Sure, it might take a while for me to get back to where I was, but I definitely don't think this company is in danger of suffering in the long term and leading to a permanent loss of capital is probably the way to look at it.
Yeah.
What do you think?
Yeah, I probably have pretty similar thoughts on that. The only thing I would add is if in the question he said, should I invest that money in something better? If there if there is an opportunity that you can see that is a really great business, still high quality business, but is at a much better price, and you don't have cash around that you want to invest, because even if you have a business that's at fair value, if it's a really great company, it's probably likely to do better than cash. So you want to deploy the cash first. But if you don't have any cash, then maybe in that circumstance, you would kind of consider doing that. I kind of did this actually in my portfolio in 2018, where I invested in Thor Industries. The first time I invested, I didn't invest a significant amount, but I was dipping my toes into it, and it fell, I think, about 30 or 40% relatively quickly. And it kind of made me realize or think, have I done something wrong? Did I do something wrong in my valuation? And it led me to do a lot more research into the company. And again, I reached a similar conclusion to you that it was a great business, but that my initial valuation was incorrect. It was too high. And in that case, I didn't actually have any alternative investments that I wanted to move that money into. So I continued to buy the stock as it fell to lower my cost basis. And I was very fortunate that that the stock fell significantly below intrinsic value. So I was eventually able to kind of save it. But who knows, what's going to happen with the stock in the future. So I think it all does come down to that last bit of your question. If there is a better investment opportunity where it's far below intrinsic value and it's still a great company, then it may make sense for you to make that switch. Yeah.
And just to forget about that part of the question before, just to bring another example to the fore, Monish Prabrai, he recently invested quite a bit into Alibaba. Alibaba then fell 40%, and he has said he deliberately sold his Alibaba shares and locked in quite a big loss because he found something better. He wanted to put the money that he had in Alibaba into Tencent through Process.
Yeah.
So he decided, yes, he did take the tax loss harvesting. That's a benefit for him to offset a capital gain. But at the same time, he did find something better, and he wasn't afraid to go, you know what, sell, I'll lock in the loss because I've done the numbers and I think that this other company presents that much of a better opportunity that I'll more than make back what I have lost plus more through this alternate investment. So that's just another example I wanted to bring forward. But with that said, guys, I think we shall wrap things up. So thanks very much for listening as always. Now we are starting to get through our Q&A questions. So if you do have a question, definitely go over to the YouTube version of the podcast and leave a comment, and we'll drag your comments in and talk about it probably in the next few episodes, because we are starting to really get through these Q&A questions, which is good. So yeah, head over, send us a Q&A question, or if there's a topic you want us to talk about, let us know. But apart from that, we will hit the road. Thanks very much, Hamish, as always, for joining me.
Thanks for having me.
I'll have to go see the Batman now.
Yeah, you will.
I'll put that on my to-do list. Maybe in the next couple of days. Maybe over the weekend I'll go see it. So anyway, we'll leave it there. Thanks, guys, very much for watching. And we'll see you, or we'll talk to you guys next week.
See you guys.